Aloha, this is Kurt Nielsen at eMortgage Hawaii, and this is my forecast for 2023 for mortgage rates, real estate, and the economy. So let's get started here. First, I'd like to thank Barry Habib and his staff at MBS Highway. They provide a lot of the information that you're going to see here today, and they're really the leading experts in the housing and mortgage industry, where things are going. In fact, Barry has won the Crystal Ball Award 3 years out of 6. He'll probably win it again this year. So thank you to he and his staff. So let's start off by talking about what is currently driving mortgage rates. A lot of people believe that the Federal Reserve is what causes mortgage rates to go up, but that is simply not correct. The Federal Reserve only adjusts the overnight lending rate, which is short-term interest rates, not mortgage rates. What really drives mortgage rates is inflation. How inflation goes is how mortgage rates go. They're kind of married together. So we need to know what is driving inflation and where is inflation going. And we made a nice prediction on November 10th that we thought inflation was going to come down, and it did, and it's had a major impact on mortgage rates. So we're going to talk more about that. So inflation occurs when there's too much money chasing too few goods. And over the past 2 years, we've had the perfect storm. We had the pandemic start. We had massive government handouts with PPP money, unemployment. We had very hot wage growth. We had supply chain constraints, reducing the production of goods and services, the war in Ukraine. On top of that, the Fed sat on the sideline for about 14 months, not doing anything to address inflation, thinking it was transitory. And in fact, the Federal Reserve continued quantitative easing into 2021. What that means is they are pouring money into the economy to the tune of about $120 billion a month when inflation was soaring. So let's look at the chart between mortgage rates here and inflation here. As you can see, they're usually married together pretty well until here in January 2021 when inflation took off because of all the things we just talked about. Yet mortgage rates stayed low for another year. And why is that? Well, that's because the Federal Reserve was still conducting quantitative easing. They were buying $100 billion a month of mortgage-backed securities and then additional treasuries. So they were pouring money into the economy, keeping mortgage rates artificially low. And as soon as they ended quantitative easing, sure enough, mortgage rates took off. Now, as soon as the inflation number took a turn last week, we've had the lowest the biggest drop in mortgage rates in a 1 week period that I've ever seen. So we knew this was coming. So let's look at inflation and what really, how we calculate inflation. It's really simple. We just take the last 12 months of numbers, add them up, and you get the annual inflation rate. Now, back in April, we knew that over the summertime, we were going to have a problem with inflation, and inflation really wouldn't make a turn until October. And why is that? Well, in August of last year, we had a very low number, and we believed that when the new August number came in, it wouldn't come in below 0.2. So you're dropping a little number, adding a big number. So we knew that that was going to be a problem. We also knew September was going to be a problem because you're dropping a little number, adding a big number. But look at here in October of 2021, we had a big number. We were hoping we would come in at or below that number, and sure enough, we did. We came in at 0.3%. So the inflation dropped from 6.6 to 6.3. Now look going forward. All of these numbers are pretty big numbers with the exception of March of 2022. That was a decline, I think, in oil prices. That was kind of short term. But these are all pretty big numbers. If we can come in every month below these numbers, we're going to see inflation continuing to drop into the summer of 2023. That is going to be great for mortgages. So we are projecting a continued decline into the summer of 2023 of mortgage rates. Okay, let's get back to inflation and why we think inflation will drop. So again, inflation is too much money chasing too few goods. But now goods production is catching back up because supply chain problems have resided. So we are seeing more goods and services. Your grocery shelves are not empty anymore. And what else is happening? So on the money supply part of things, well, the federal government, at least for now, stopped spending so much bloody money on PPP and unemployment. That's good. Also, interest rates are rising. And what does that do to people? They want to start saving more. So that'll pull some money out of the money supply. As interest rates go up, you can get better return on your money, so you're not going to go spend that money as much. What else is going to happen? Well, we think that we're going to head into recession, and unemployment will grow, and that puts less money into the market because people are losing their jobs, and we're already starting to see a turn on that. So we see going forward less money supply, and the Fed is continuing to raise rates, which reduces the money supply, and more goods and services being produced. So everything looking forward looks good to help reduce inflation. So we think that's the way it's going to go. So now let's talk about recession, because recession could have a big impact on housing and mortgage rates, and so we need to know where we're heading there. So every time the Fed has hiked rates significantly, it has put us into recession. Hiking, recession, hiking, recession. So you can see the impact of Federal Reserve rate hikes. It does push us into recession. So now we've had a pretty dramatic increase in the Fed rate, and we believe that that will push the economy into a recession of some kind. Now the question is about whether it's going to be a hard landing or a soft landing, and we can all argue about that. Also, another indicator is the yield curve. So normally, yields like on treasuries or mortgages, the longer you lock up your money, the higher the interest rate you get. That makes sense. You're only going to lock it up for a few years. You should get a lower interest rate than if you locked up your money for 30 years. But that's not what has happened. So this chart shows the 10-year yield minus the 2-year yield. So every time it goes below zero, that means the 2-year yield is higher than the 10-year yield. Every time we've had what's called an inversion, we've gone into recession. Inversion, recession, inversion, recession. Now we've had one of the biggest inversions that we've seen in 40 years, and we think that that's a strong indicator of recession. Okay. Another indicator will be unemployment. So every time unemployment bottoms out and turns and starts to rise, we head into recession. Bottoms out, rises, recession, bottoms out, bottoms out. So we have bottomed out. We have had a turn in unemployment, started going up a little bit. So we think that's a good indication that we are heading into recession. And just anecdotally, you can hear in the news, many companies are laying people off. The tech sector and some others, even there's hiring freezes at Apple and Google. So we are going to see, I think, unemployment continue to tick up, and that should push us into recession, I think, into 2023. But that's not all bad news for mortgage rates. Every time we have a recession, mortgage rates drop. So you can see, and pretty big drops relatively. So here, when we are in this low rate environment, which we will probably stay in for the next 10 to 20 years, you get a drop in the mortgage rates when you go into recession. And we have now started seeing a drop in mortgage rates because of the CPI number last week, but we expect that to continue. So that's kind of good news, at least for us mortgage brokers. So let's talk about housing supply and demand. So one of the things that everybody should know about is housing is normally a very good investment throughout a recession. It normally doesn't drop significantly like equities do. So if you can see all of these recessions, real estate usually does pretty well, with the exception of 2008. And 2008 was a much different situation and could have been predicted if you were watching the demographics. So let's look at the demographics. So back in 2008, the blue bars are showing household formations. So household formations were going up until 2005, and then they collapsed and stayed low for 10 years. On the other hand, builders were building more homes than in the history of the United States, over 2.2 million homes in 2006. And this is at the same time when household formations were collapsing. Now, the reason they kept building is because we had very low lending standards and people were buying multiple properties, speculating on the continued rise of housing values. So you had bartenders buying 2 or 3 properties, knowing they couldn't qualify for them, but they were going to hold them for a short period of time and make a killing because the values would go up. So you can see they were continuing to build even into 2011 above or equal to the household formations. And now we're behind. So for a long time, household formations have been greater than construction. And again, we can go back and look at some demographics to see how all of this happened. And you'd have to go back 33 years. So in 1972, we saw a dramatic drop in household formations, and it stayed low for about 10 years. And why is that? Well, in 1972, the Supreme Court legalized abortion. It reduced birth rates for a good period of time. But now we're heading into some bubbles. The millennials and the post-millennials. Millennials are entering the real estate market, and the post-millennials will be right behind them. And that's the biggest population bubble since the baby boomers. So now we have increased demand, increased household formations, and we're not building enough homes. Okay? So if we just go back to this, we're now about 3.5 to 5 million homes behind in supply. Depends on how you count it. We've had a lot of immigrants come across the border which need to be housed. So if you add in, the number of homes to house them, you're probably getting closer to 5 million homes needed in this country. But let's look at the demand for household formations. We're about 1.7 right now, and that's because of the millennials entering the market, and the post-millennials will be right behind them. So let's say we have to build 1.7 million homes a year. Well, the starts are almost there, where about 1.7 million homes get started or plan to start. Now, we do lose about 100,000 homes a year to hurricane and fire, so the new supply is about 1.6 million homes. But And knowing that the demand for household formations is about 1.7 million and maybe going up as the millennials enter the market. But you would see that there's still a deficit just on housing starts and household formations. But the real problem is completions. Completions are only averaging about 1.4 million a year. We lose 100,000, so the new supply is only about 1.3 million. So we're still 400,000 homes short every year. So this does not make a housing bubble when we're millions of homes behind and falling further behind. So until we get housing starts completed up around the 2 million homes a year range, we're going to be in a deficit supply problem in the housing industry, which means housing values will stay high and demand will stay high. Okay, so let's look at inventory. I heard some pundits saying, oh my gosh, inventory is skyrocketing. That's the indication that there's going to be a housing bubble. But if you look at historically, we're at such a very low supply, and it gets worse when you really dig into the numbers. Okay, so the existing home inventory, the real story is we have about 1 million homes in inventory. 600, I think this is back in August, 600,000 of those were already under contract. So you really only had about 400,000 homes available to purchase, which is, we've never seen it that low. It may soften up a little bit, but you can see that we are just simply at one of the lowest levels. We are at the lowest level in U.S. history in terms of existing home listings. Now, this is turning a little bit because demand of buyers, kind of fell off because of the high mortgage rates, but we expect that to turn around as mortgage rates come down. So there is a bit of a window of opportunity for current buyers, but it's going to be short-lived. Okay, and look at the vacancy rates. If you're a landlord, you've never seen a vacancy rate under 1%. That's never happened. So if you own a property, you very likely could easily fill it, and that's what's driving rental prices up. It's almost 8% escalation year over year, and we don't expect that to slow down. So that will continue driving real estate prices and rental cost. So just more reason for new home buyers to buy. The other thing we heard in the news about foreclosures jumping, and that's a housing bubble for sure. Diana Olick addressed this in MSNBC. So, but if you look historically, we're still at the very lowest in terms of foreclosures. And why did we have such low foreclosures? Is because there was a forbearance on foreclosures in most states. You couldn't foreclose, and people got a free ride and not paying their mortgage for a while without having them being foreclosed on. So you had a lot of people not paying the mortgage, and the banks were not able to foreclose on. Now they're now doing that on people that have not resumed paying mortgages. So there is another little opportunity here, I think, for home buyers to look for some foreclosures, maybe a dilapidated home that they can turn around and fix up. We can, on a primary residence, we can lend 95% of the cost to buy the home and 95% of the cost to remodel the home. So that's a real opportunity to get some extra equity in a home in today's market. So what do we think of housing in 2023? Currently, mortgage rates have curtailed demand and slowed the price growth in real estate, but that's beginning to turn. And this is an interesting statistic. 90% of all homeowners have a 30-year fixed rate mortgage at historic lows. So they can't sell really until rates come down, because they give up a 3% mortgage for a 6% mortgage or a 6.5% mortgage. It may not be affordable to them, so they get kind of locked into the current home. And again, home prices are protected as homeowners are not motivated to sell at lower prices with higher mortgage rates. Very few are forced to sell because they have very low mortgage rates and they're very affordable. So they're not being stressed to stay in their home. Only distressed sales can drive the pricing down, and that would only be through really bad recession and high unemployment. So as interest rates continue to decline down to the 2020 and 2021 rates, locked up homeowners will be able to sell and buyer demand will soar. So housing activity is going to rise. 2023 could be a crazy year, especially in the second half. But again, if you're sitting on the sideline, now is the time to buy. So why buy now? Let me just do a little analysis with you on a buy versus rent. This is just a quick analysis. I'm using a very high interest rate. So let's say you go out and purchase a home for $1 million and you put $100,000 down. You got a 30-year fixed rate loan at 7.5%. And let's go out 10 years and see how this looks. Okay, and we got all the costs built in of property taxes, maintenance. The appreciation rate I have on the house is 4.75%. The 63 historical average in Hawaii is 5.09. I think it's going to be quite a bit higher because I think we're short on supply. And you compare that to monthly if you went out and just rented the same property, and let's assume a 6% year-over-year rise in rent, which it will probably be higher than that. So if you do the analysis, if you bought a home, over the 10 years, you would pay out about $68,000 more than the renter. Okay, about $6,000, $6,800 a year, a little more than $500 a month. It's kind of a forced savings plan. But look at the benefit. $707,000 appreciation gain. You paid down your mortgage $137,000. So now you're at what, $844,000 gain. And we're not even throwing in the tax benefit that you get for mortgage interest rate deduction on your tax returns. And that's different for everybody, but pretty amazing numbers here when you look out just 10 years. Okay, so again, an $849,000 gain over 10 years doesn't even take into the tax benefit. So buying that house, you start with a net worth of $100,000 and you end up with $949,000 at the end of 10 years. I mean, my gosh, that's almost earning $85,000 a year over and above your job. It's like having a whole nother job. Now, let's say you took that same money, invested in the stock market, it would have grown from $100,000 to $235,000. Nice gain, but nowhere close to what real estate does for you. And why is that? It's simple. Leverage. Real estate you can borrow to buy. So you can take $100,000 and tie up $1 million home. You can't take $100,000 in cash and invest it in the stock market and tie up $1 million worth of stock. It's just not possible. If it were, everybody would be putting their money into the stock market. So the difference in wealth over that 10 years of the buyer buying a home versus the renter renting is $714,000. Now, this is one other thing you should take a look at. What if I just waited 1 year to buy that $1 million home? I would lose the benefit from year 9 to year 10. How much is that? $135,000. That's the benefit lost by waiting 12 months to buy. That's more than $10,000 a month. That's more than the cost of the home. It's the monthly cost to own that home. So waiting is just a bad choice. And this analysis assumed that that person never refinanced their mortgage. When rates come down to 3%, if they refinance their mortgage, these numbers would be much better. So, you make the decision. If you want me to do an analysis for your client, or if you're a buyer, you want me to run some scenarios, I'd be happy to do that for you. And investment is the same way. I'm not going to go through the details of this, but if you are a landlord, you can generate some very good returns. I went through an analysis here, the cost of owning a property and what the rents would be, and went through the cash flow analysis. In the first few years, you're negative cash flow, but as the rents go up, you're positive cash flow. But more importantly, the gain in wealth of a small investment of $100,000, you gain another $329,000. This is over, I think, 9 years. 17.6% annual rate of return. I mean, you can't ignore these kind of numbers. The benefit is obvious that real estate, even in a high interest rate environment, is the place to be. So what are our conclusions? Mortgage rates should continue to a slow decline beginning this fourth quarter and throughout 2023. The Federal Reserve will push the economy into recession if we're not already there. Housing is the safest investment for the next 5 to 10 years. Even with the higher interest rates and never refinancing, investment property returns a 17.6% rate of return. And that's why a lot of homeowners, even when they move, they're keeping property because rents are so good. Housing will remain tight until we really unleash construction and start building a lot more homes. Only a serious world event or recession, depression could cause a decline. As interest rates drop in 2023, the sideline buyers will re-enter the market, causing another spike in values and another buying frenzy. This time we will have a lot of sellers entering the market that have been pent up and kind of locked into the home, so that will help a little bit on the supply side. I think buyers have a window of opportunity for the next 4 or 5 months. Sellers are a little bit more flexible right now, but I think that will go away as buyers enter the market with lower interest rates. Buyers should ignore high interest rates. They're better off absorbing a 3% higher mortgage rate than waiting a year or more, maybe 2 years, to pay 5 to 15% more for the property. They can always refinance when the rate comes down, so they're not going to be burdened with a high interest rate for very long, maybe 12 months, maybe 24 months, that's all. Listings will return as a gold mine for realtors, especially with all these pent-up sellers. Once rates drop, buyers will come rushing back into the market. So I would be preparing sellers, especially those that want to move but can't move right now. So you need to really differentiate yourself if you're a realtor to attract listings. We have a program that we can help you with. I think it's a dynamite program, so you can call me on that. And there's another idea. If you have a listing right now and you want to differentiate your seller, you can offer a buy down. So can you imagine if a buyer's looking at buying a property and they can get let's say a 3.25% rate for the first year, 4.25% for the second year, and 5.25% for the third year. I mean, that could change everything for that buyer. It doesn't cost the seller that much. It's certainly better than decreasing the price of the property. So call me if you want to talk about buy downs. That's one way to differentiate a current listing. So, okay. Well, thank you very much for spending some time with me. That's our forecast for 2023. If you have any other questions, feel free to call me. I'm available at the number shown on the screen.